Good afternoon. Hi, everyone. Thank you for joining us. Hope you're having a lovely conference and you're nice and awake after your lunch, which was probably mostly bread and potatoes. I'm having a little bit of a carb slump myself. I am Mandy Kirby. I'm Director of Reporting, Assessment and Accountability at PRI. And normally that would mean investors would run away from the room, but we're not talking about accountability today, and we're not talking about investor reporting. We're talking about corporate reporting standards instead. And this is an increasingly pertinent topic, and we're going to be thinking about how investors can start to get the information that they need. So investors need to have that reliable information so they can make their sound long-term decisions. And they also need to be able to understand where they sit themselves in the global market and how to measure their own impact. And there's lots of debates that have been around reporting on increasing reporting burden. And if you were in the session before this, that was something that came up as well. And also the role of intermediaries and how to make sure that there's good connections between investors and companies. And then there's issues around availability of data and the quality, particularly, of ESG data. We're increasingly seeing investors wanting to be able to do that strategic long-term outlook on their investments, but having only that historical data that they can look at. And we've also heard throughout the conference, particularly in the plenaries this morning, some really interesting insights around things like climate inequality, how there's an interoperability of factors like the effects of climate migration and so on. And now we're thinking about frameworks like the UN Sustainable Development Goals, which are potential game changers in the way that people are looking at information, and how you do that alongside trying not to create new frameworks, new standards, new ways of reporting. So I'm absolutely delighted to have to discuss this with me today Richard Howitt, who is CEO of the IIRC. Lots of acronyms as well happening now. And then George Dallas from ICGN, who is policy director there. Amisha, Parekh, who is from Bloomberg Sustainable Business and Finance team, and Eszter Vitorino, who heads up the capital markets program at the GRI. What I'm going to ask the panelists to do is do a very brief introduction around what their organizations are doing in this space. And one thing that we know is happening at the moment is there's a very collaborative environment at the moment, and there's lots of dialogue happening, lots of collaboration, which is excellent. So everybody here today is kind of wearing another hat as well. So they're representing their own organizations, but they're also going to be able to speak to you about their involvement in other initiatives. So Richard will be able to speak about the corporate reporting dialogue. George is going to talk a bit about a group of investor organizations that are coming together on this topic. Eszter is going to be able to speak a bit about the collaboration between PRI, GRI, and UNGC. And Amisha is also going to talk about some of the things that Bloomberg are involved in, for example, with SASB. So we could have had 150 people up on stage talking about all the different things going on. We've chosen this for you. We will try and represent all of the other things that are happening as well as we go along. So, Richard, I'm going to go for you.
Well, thanks, Mandy. Thanks to you. Thanks to UNPRI. Some people in the audience will know me, but I'm a new chief executive, just less than a year into it, although an advocate of integrated reporting throughout all of the years of the International Integrated Reporting Council. And UNPRI, you are our very valued members of the council. You've endorsed integrated reporting. And as you say, we've driven forward the whole concept of integrated reporting based on collaboration and partnership. This is not a new or additional form of reporting. This is about collaborating with this new thinking that we're all here to discuss, but then trying to mainstream that to within the corporate reporting system of the world. And that's why our work at IIRC so much chimes in with the sessions that we had in the conference yesterday about creating a sustainable financial system in the world, because this is very much about system change that our focus exists. We've been going for 7 years. We now have 1,600 global companies doing integrated reporting in 62 different countries. But as some of our partners in the audience, GRI on the panel, this is not a numbers game. This is not a competition. This is how we are together involved in the process, as you rightly said, Mandy, to change corporate reporting, to switch to this new, what we would call multi-capital thinking. I think the The focus that IIRC particularly brings on this is not just ESG, but then how is that ESG information really integrated in a way that investors can see the effect on the performance of the company, its strategy, its business model, and the aim of long-term value creation. And we never apologise for the fact that we say that the investor is the primary audience for of the integrated report. We were formed on off the back of an understanding that traditional accounting was missing 80% of the value of the company, and the intangibles was too far backward looking, was too siloed, had missed climate change, had missed the financial crisis, was challenged by long-termism. And so this great global coalition came together, the leading businesses, investors, regulators, to try and drive this change, and it's a deeply exciting thing to be involved with. Today we are, with this session, releasing this new document where 12 members of UN PRI and of the IIRC, representing $2 trillion of assets under management, are all saying that they don't just value integrated reporting, but they use it. They really do use it. So that's, I know it's the latest of a number of investor statements. There will always be more, but that's another marking point that we announced at this conference to show that progress really is being made. As you say, Mandy, our convening of the corporate reporting dialogue is deeply important. When we talk to businesses and to the market, they don't want lots of competing frameworks. What they want is a process of alignment, and they do want this to be integrated in financial reporting. So with our friends in the GRI, and it's Eszter's birthday today, you've revealed, am I allowed to say that? I'm not allowed to say that. So don't wish Eszter happy birthday, whatever you do, but happy birthday, Eszter. But with our friends in the GRI, CDP, CDSB and SASB, but also our friends in the International Accounting Standards Boards, IASB and its US equivalent FASB, we've together now over 2 years driven this process of alignment between the frameworks. We have a common mapping exercise. You can see how they all relate to each other. We've got a common founding definition of materiality. We're doing work together on the SDGs to complement work that Eszter's going to talk about that the GRI are involved with. We're analysing the benefits of reporting, not just reporting for reporting's sake, but how it's really leading to behavioural change. And with our friends from Bloomberg, we're not quite there yet, but we're in the very advanced stages of agreeing an extremely exciting project which will see the alignment of all the frameworks together with the TCFD recommendations. Much more to say, but I think that's my time, and I look forward to the discussion. Thank you.
George.
Okay. Thank you. Thank you also for including me in the conference. It's an amazing event. For those of you who don't know ICGN, we're a membership, investor-led membership organization, members based in 45 countries around the world, very much a global organization, and our main emphasis is on promoting good governance by companies and also responsible investment practices by investors. And our first policy priority, we have 5 of them, not 17, but we have 5 policy priorities. And it's basically trying to promote a long-term investment perspective for sustainable value creation. And it's in that context we're looking at systemic issues as well as ESG issues as fundamental to what is driving companies. As Mandy mentioned, I think one of the reasons I'm here today is not just to talk about ICGN, but also this project that various investor groups, including PRI, who's convened it, UNEP-FI, and several others, to try to be a foil, if you will, for the reporting community. And I think that this was prompted by a meeting last year, I think that IIRC sponsored, in which I think the gist of it was that the investors are all over the place, and can't they get their act together and tell us what we're looking for in ESG reporting? And that prompted the formation of this group. And I don't know if Chris Duma is in the room, but if he is, right? He's not. Oh, he should be. He did a lot of the yeoman's work on putting together a discussion paper that this investor group has been preparing over the past year or so. And just a few highlights, and maybe we'll be able to come back to them. Not a surprise for those of you here particularly that ESG is growing in importance to investors, not just for investment decisions or valuation, but as Richard mentioned, increasingly stewardship activities and communicating with companies. It shouldn't be a surprise that there is none, and there's likely not to be any single homogeneous solution for how investors will use ESG data. There's simply too many investors pursuing lots of different strategies, and to some extent, investors will stay all over the place, and maybe that's not necessarily a bad thing. But I think there are some common points that we will be communicating later to the CRD next month, in fact, that we certainly, investors are wanting and increasingly expecting companies to publish ESG information, not only the data points, but how it's managed at the executive and the board level. And I think key to my colleagues here is also increasingly to weave these dimensions, not in a siloed report, but in a integrated report, basically blending financial, operational, and strategic types of information together to try to develop the strategic thinking that we're trying to promote. So I think we're certainly on that same wavelength. And I suspect if there's one area where there's a lack of consensus or where we still need to do a bit more thinking, and potentially this could come through the dialogue with our friends at the Corporate Reporting Dialogue, is the question of standardization versus customization of ESG data and reporting. There's advocates of standardization because it makes comparisons a bit easier. The customization argument would suggest that ESG risk is so endogenous to individual companies, it's meaningless to establish a common standard. And I think where our working group is coming out is that maybe there's going to be a mixture of the two that might be some form of equilibrium. But obviously, that might be resolving one question. If we are moving in a direction of some form of standardized ESG reports, the question then is whose standards and how is this done? And I think that remains an open question too. So Mandy, I'll just stop at this point, and I will want to say a couple more things about the integration of these different bodies together, but I'll save that for later.
Thank you. Thank you very much, Mandy, and PRI for having me here. I think as I hear your panelists, Eszter and I were looking at each other in full agreement that it feels like what we're going to say is fairly similar. What I've been doing the past few months at Bloomberg have been talking to many of our investors to really understand how they approach sustainability and ESG integration or engagement with companies. In addition to that, we also have corporate clients, and a lot of the work has involved educating them on investor needs and how investors look at the data that they're publishing. And as I think about this panel, there were three themes that emerged for me. The first, I think, George, what you said is investor needs vary based on the investment style, the asset class they're looking for, and there is a role for each reporting framework that hits their needs. There is no, and still there are gaps in their reporting requirements. What you also see, though, is a challenge with data quality. That's really where they want to understand how was this created, this data element that I'm seeing, what is really included in scope there. So I think that really there is a room for everyone to play, and if I think about Bloomberg, that's why we do support many of the reporting standards that are out there, and Mike is playing an active role in SASB and TCFD. And then if you look at, well, where are they in their educational journey and maturity? I think there's a need for education on both the corporate and investor side on the data. Really, if I think about our products, Bloomberg Intelligence has BI ESG, and what Greg Elders tries to do in that space is highlight the elements that are most material from an investor perspective so that an investor that's looking to make decisions on a sector, they can quickly get smart about it. And I think as data providers or information providers, that's a big role we can play, is bridging that gap, because now if you're a company, you can look at that data and say, what are my investors looking? What is material from an investor perspective on that topic? The other thing I think we do in that space that's really unique is our sustainable business summits. And what we do in that space is bring a day of finance professionals and another day of corporate professionals, and they get a chance to get together and talk and understand both aspects of the story. And then the last takeaway I had was investors are looking for greater transparency. As this market matures, there is value. They want to go behind the qualitative research. They want to understand really what is driving a score. Where is this coming from? And that's really what we were talking again about being busy. And what's driving us is we just launched a new scorecard. And the point was, let's take company reported data and let's make investors make these choices. Let them figure out which of these variables are important for a sector, develop their own scores, and I think what that'll play a role in building this community is engagement between companies as they start looking at the data, understanding the sectors, and developing their own scores. So,
thank you. With that, can you hear me? Oh, it's on. All right. Yeah, thank you for the opportunity to be here and speak among friends. And I feel like next time we need a huge whiteboard so that we actually explain how all the things we do and how it all mutually fits together. I just had a conversation over lunch with a reporter, a data provider, who said, it's the SDGs reporting and the TCFD and the integrated reporting and the sustainability report. And I don't understand how this all fits together, or maybe we do understand how it all fits together. But focusing on all the effort to provide data takes our attention away from what actually it's supposed to serve. It's supposed to serve the ends of sustainable development and responsible business practice. So going back to the point of businesses doing this for a purpose and not as an end in itself is so important. And maybe sometimes we just think it's clear and straightforward for everyone, but not necessarily. Again, I think, as you all said, we need to look at both sides of the coin. We need to look at the data providers, the reporters. Now, GRI provides the sustainability reporting standards for corporates to report on their ESG impacts and outcomes. But increasingly so, while we're a multi-stakeholder organization and our standards have been developed in collaboration with business, labor, civil society, academia, etc., we've always considered also the investment community as an important user of this data without necessarily putting them as the only user of the outcomes of what companies report on. I understand very much that we need to provide more support to reporters as well to improve the quality of data, the comparability. And it's done in a collaborative effort. I don't necessarily think it's about thinking about new frameworks and new solutions. It's about going back to what we know is and improving the rigor with which these reporting principles and frameworks are applied. And when you look at the work of SASB and GRI and CDP and IIRC, they all fit together. And you can, in principle, what we all would like to achieve is report once, use many times. It's about doing a good job at the front end so that then the back end can make use of it. And that's why we're really glad to actually have been working with you in Global Compact and GRI on the corporate reporting or business reporting guidance for the SDGs. There has been a document launched last week in New York at the UN General Assembly looking at what are the indicators that businesses could potentially report on in terms of their SDGs, which is really great. And the next phase is really making sure that business reporting is investor relevant. And that's why we're really eager and keen and happy to collaborate with PRI and kind of bringing the perspectives together and providing guidance to corporate reporters to make sure when they apply that SDGs lens to their corporate responsibility reporting, that the outcome is and remains investor relevant.
Right, thanks, everyone. So we're going to do a bit more of a deep dive on some of these topics, and then we will come back to the audience for questions later on, so hold your excitement until that point. Richard, if we can come to you first and talk a bit more about long-termism and what that means around the reporting structures that you've got, and certainly also the themes that came up in the plenaries this morning. We're talking a lot about the interconnectivity of issues and what can you do around that with your integrated reporting.
It's almost trite to say that we should all shift to long-termism. Everyone in the audience will agree with that. You agree with that, I agree with that, we agree with that. But the issue is that when we leave this conference, we're going to go and find 500 emails waiting for us and a packed diary. And we all of us, let alone all the people we're trying to influence out there, are stuck in this short-termism, which is very, very difficult shift. However, the rhetoric is definitely there now. The work that UNPRI did with others on the shift to long-term investment at the World Economic Forum that I was involved with in my former post now 2 and 3 years ago, I think has become embedded. We're very excited by the establishment of Focusing Capital for the Long Term, which has really put a new focus in the international debate on this, and one of our partners. And I suppose the trick, there's no simple answers to any of this stuff, but the trick is long-term but no expense to short-term. It has to, and investment community would be the first to say that. You know, there are trade-offs to be had, but you have to say short-term, medium-term, and long-term together. And then the trick of integrated reporting. We don't claim the concept of integrated reporting as the answer to every evil in the world and every economic challenge in the world. But what we do say is that it is the tool in order to pursue some of those objectives, the switch to long-term investment being in them, and whether it's the work of the task force or the high-level group that got excellent showcasing here yesterday at the level of the European Union, each of those sees alignment of the different frameworks, integration, and each of those has the concept of integrated reporting, an integrated view of risk management are all the way that you switch to this new, longer-term, more inclusive vision of how the economy works. And it's up to us now to try and fill in the detail.
Thank you. And then if I just bring in George, because we had some conversations around this, and it's, as we said, a topic that also came up this morning around stewardship. And in the session before this as well, what really came through was that this is something that boards should be looking at, and maybe you could speak a little bit to those points.
Yeah, I think we spend a lot of time at ICGN, or I think we all do, probably everybody here hopefully thinks about stewardship issues. How can investors do their job better for their beneficiaries by monitoring, engaging, and being on top of their clients? And what do you talk about? Well, there's any number of things that one could talk about, but obviously the long-term agenda, and it is trite to say it at a level, Richard, but I think we need to say it again and again and again, because otherwise it's not going to happen, because I think the pernicious realities of short-termism is very difficult. But I think what we want to do is, as an investor group, firstly working with good information and data that we think is reliable and helps us to assess risk, is to use this not only making investment decisions to invest yes or no in a company, what does this imply in terms of valuation, but also to use this as part of a dialogue with companies. And so part of this is certainly giving investors more information to work with, but also, to your question, Mandy, it's also making sure that we're establishing the expectation with boards that they should have these types of conversations with us, because I think this is, from our perspective, as a governance perspective, obviously executive management plays a critical role, but so do the boards in terms of setting the tone through the organization. So certainly a big part of our own stewardship principles, one of our 7 stewardship principles is relating to ESG integration. And this is something that we will be, the investor community, I think, does need to address more systemically. And I think as we get better information, both the data, but also the narrative, and I think the narrative that comes is also essential to pull these pieces together in a bit of a holistic view. I think that's not only good for investors in terms of trying to understand companies better, but it's probably helpful for companies in terms of understanding themselves better and potentially also being able to benchmark themselves against who's doing these issues well or poorly. And so I think that the stewardship dimension to this is big. And well, I'm sure we'll be talking about sustainable development goals in a bit. And the challenge gets more complicated once we start adding all of these into the equation. But I think the stewardship piece is, I think, fundamental to the information in the reporting that we're looking to achieve.
Did you want to add anything on that?
Only that the concept of stewardship has been a huge driver in all of this. Stewardship of investors for the beneficiaries, of course.
Yep.
But stewardship of all of us for the wider consequences in our world, the switch to long-termism. And if you look in both stewardship codes and corporate governance codes worldwide, there's a sweeping change taking place. And if we're talking about creating a sustainable financial system in the world, that's one of the key drivers, not the only one, but one of the key drivers of how we're doing it. And this year, whether it was the change in the Dutch code, whether it's the new Malaysia code, and that's just in this year, it is our friends in the International Corporate Governance Network who've put this in their model global corporate governance code. These concepts of stewardship and good corporate governance are key drivers on how we're going to get integrated reporting and a new sustainable financial system for the world.
Can I add one more thing, Mandy, which is sort of linked to this? I think a lot of the early ESG work, and ongoing, and it's still developing in many ways, is looking at how ESG affects an individual company, sort of a micro application of this data and this information. And I think that is important and will remain so. But I think what we're also beginning to recognize, whether it's sustainable development goals, whether it's just awareness of broader issues we face societally, I think there is systemic issues, thinking not only about how this company is going to be faring that we're investing in, but we also, lots of companies together form markets and economies and societies. And even if we look at this through a prism of self-interest, I don't think you need, it still can affect, it certainly has social implications, but systemic risks clearly are relevant for investors that do have a long-term perspective. So I think the challenge for investors in some ways is not only doing this work better at the individual company level, but then also beginning to think a bit more broadly and systemically about what can and should we do to try to address some of these broader issues, whether it's climate, whether it's human rights, or other broad issues that do affect not only individual companies, but society more generally.
5 seconds. I see in the audience the Japan Financial Services Authority and also our friends from GPIF, the biggest investor in Japan. They introduced this in their stewardship and corporate governance codes, and it's been a huge driver there. So it would be discourteous of me not just to say that.
Thank you. And so is this something that, George, when you mentioned that investors should be looking at this in a systemic way, is that something they do alone, or should it be a broader initiative?
Well, I think stewardship involves collaboration, doesn't it? I mean, and I think particularly with systemic issues, I mean, for some in this room, this is not new stuff. For many in the investment community, it is. And trying to feel one's way through new sets of issues, new sets of data, I think, whether it's a PRI convened, I think that we will need to be working together in a constructive and a collaborative way, both to understand these issues, perhaps to communicate to standard setters and data providers a bit more coherently than we have. And so, I think this is very important.
Eszter, you wanted to come in?
Maybe I just wanted to actually check with the audience. How many of you are involved in the actual act of reporting on sustainability performance or impacts? I would say it's maybe between 5 and 7% of the audience. And if I can ask, how many of you are involved in using ESG data for your work as decisions? So that's the majority of the audience, which I think determines, of course, also the storyline. And we just have started working on a project with the World Business Council on looking at, when investors and data users look at the data, they want to find meaning in it, and they want to look at it, and they want the data to help them make a better decision. Now, when you look at the data provider side, meaning the data producer, the reporter, I think it's not so uniform. So often, as we know, sustainability reports are issued by the CSR team, which is not necessarily talking to the investor relations team, and more often also not necessarily aligned with the CFO and the accounting team. So what we were looking at is actually having a reporting strategy as an organization. How can we achieve that? And the reporting strategy should be a result of an overarching business strategy, and this plays very much to the strength of integrated thinking or integrated reporting. And it doesn't matter so much in the end what's the format of your report, as long as you actually have thought through what are your overall risks and opportunities and impacts of your business and your products and throughout your supply chain. Only by thinking through that and then understanding what's the business strategy, what should be the reporting strategy, what time horizon are you looking at, and therefore determined by the time horizon you consider, what's your definition of risks, and therefore what type of ESG limited or broader set of issues you will be looking at, then you will get a fuller picture of the organization at large. And then hopefully that data will also become more useful on the user side. So part of the problem is just the disconnectedness at the reporter level, individual reporter level, and of course, it's still just addressing the micro level, not the macro one. But I think we need to a little bit decompose different elements that will take us to a solution and see how we can progress the conversation at the company level to help reports become more useful. So I think it's something we would like to all achieve, and I think we all have a role to play in that. I think investor reports and dialogues are irreplaceably important, direct engagement, but there is a mutual learning that we all have a role to play in. So, yeah.
So we did touch upon briefly earlier the idea that, and I know this came up in the session previously, that investors are not looking at the information that's being provided for them. So we know that some of you are, which is great. But there is clearly some kind of disconnect. And so the PRI is one of the conveners of the Sustainable Stock Exchanges Initiative. And this has been a really strong focus for them to try and play a role in closing the gap between companies and investors, and to let companies know that that information is valuable and that it is being used. But maybe, Amisha, you can talk a little bit more about data quality, and actually you mentioned a little bit earlier about educating investors, not you guys, educating investors on how to use that data better.
Yeah, I think, and as we were talking earlier in the panel, there were two themes that came out. There's a lot of noise about there's too much data. And I think that's fair, but because there are so many different investor types and investor styles, their needs are different. And if you're a company, yes, you're burdened by reporting to these different needs, but that drives a little bit of, well, there's still not enough information that's been addressed, and continues to leave the hole for one-on-one engagement. So, for example, if you're a fixed income investor, there is very little information outside the company reported data unless you're issuing a green bond. So how is an investor supposed to know beyond certain governance factors at the company level? And what we hear from people is they will engage one-on-one with companies. Now you kind of go to the quality challenge. You have too much data, not sure where you want to use it, and you go to the quality challenge. And here I think where I see the gap really is the audience may not be sure what they're looking for, but they also don't hold companies accountable. So one of the things we recently did was Bloomberg New Energy Finance looked at all green bonds issued since 2014. And there were 500 plus bonds, and we studied what were they reporting? Were they in compliance with what they stated when the bond was issued? And what we found there was most companies reported, most corporate issuers reported, but the variance on timing, the frequency, the quality of the depth of the report, but the biggest challenge was reporting was not detailed enough that you don't know if your money is going into green coal versus a true green investment. So where is this money going? So all these standards say you must say X, Y, and Z, but really that quality debate and holding them accountable, I think there is a role for us as investors to go back to those investments and say, hey, you didn't report about this. We talked about it. I made a bet. And there is, I think there is a little bit of that corporate engagement portion needs to play a bigger role. And I think the last bit is also just an education burden on data providers, but there is also a focus on quality that we need to put on the issuers. So if, Bloomberg has a standard where if your data quality doesn't meet a certain level, at least in our checks, we won't publish it. So then the company engages with us and we give them the justification for why their data wasn't published. But there is that role we could be playing more as issuers to drive that better data quality and transparency, along with company engagement to up their game and educating them what investors are looking for. So.
Could I just say quick?
Yeah.
My 5 seconds. Sure. Quality also relates to assurance.
Yes.
And that's a big issue that gets accounting firms very nervous.
I come from my former background is from an accounting firm, so I will say they want to do it, but they are very nervous about accounting if there is no clear standard, because now they bear the risk of assuring something. And that goes back to the whole standard cycle, yes.
Absolutely.
So I don't know if you want to respond on the assurance point, and then we can maybe talk about SDGs after that.
I can. That's to be very, very transparent. When the G4, the previous set of guidelines, were issued by GRI, there was a recommendation to, we recommended external assurance for sustainability reports, and then we did more research into it, and we talked to stakeholders around the world, and we kind of took a step back because we saw that there are so many open-ended questions still in that practice, and of course the costs and the scope of assurance, and yeah, so there's so many questions that came up that we thought we need to wait before we can, again, step out and take a stand on assurance.
Yeah. Just if I can jump in with one point on the assurance, if we look at what people assure, when companies report, they will generally have a statement, our carbon data is assured because there is a standard there are scope limitations set, so there might be some level of consistency. So wherever there is no standard and the topic is a lot more qualitative, it's just going to be really hard, and the more topics we add to the agenda, the burden of the assurance, the cost of the assurance is really going to drive companies. So I think it's incumbent upon us in this community to really say, let's align on those metrics and try to at least make sure how each metric is defined in the reporting standards.
On the question of standardization and robustness and credibility of metrics, none of us have got all the answers, but in this multi-capital view of the economy and of the world, clearly that exists for financial and manufactured capital. We would argue that on the natural capital space, there's been years of work on all this. The metrics are there. You can have an argument about credibility and which are the best ones, but to suggest that they're not pretty well developed is, it's just not true. On social capital, we're well on our way there, but we talk about the hidden capitals, which is human capital and intellectual capital, where frankly I think there is much less development in the metrics, and we see our role not as prescribing in any of those metrics. That's not the role of integrated reporting. We're the umbrella, we're the high-level principles aspect that's bringing it all together. But to stimulate that and to work with partners in the academic world and elsewhere in order to get the metrics more robust. And then the question is how you get them then agreed in a way that then they're used in a popular way. No one's got the absolute answer, but we see this as a experimentation testing and then the market saying which are the most credible, and companies do not want, you don't need to tell you, to have lists and lists of metrics that they have to respond to. It's just seen as a cost and a burden and not linked to their business strategy, what integrated reporting is all about. But if they can see those metrics and then choose from them which are really material for them and then apply them, that is what's going to be useful for the companies and for the investors. And on the assurance part, I think we're going through the same thoughts that GRI has, and also with them. But my own view for today's session is that if this is the end game of what will become the norm of corporate reporting, not additional add-on reporting, but mainstream corporate reporting, I cannot see why assurance won't be part of that. And although the questions that you raised are perfectly proper and we all get them and we all hear them, I was associated in my past with the European Non-Financial Reporting Directive that you've heard a lot about this week, where we chose to assure on the process rather than the content. You can also assure on the consistency between the non-financial report and the financial report. You can also, as accountants know, have different levels of assuredness in the assurance. So there's some different models there that are available to us. But I think that this discussion won't go away. Companies are always going to be worried about the cost. But in the end, to an investor audience and from an investment point of view, we want assuredness about the metrics. And I do see this as being part of the end game.
And if there's something that a company and investor would agree upon, companies don't want to have the cost, particularly if assurance is involved with more and more. But investors don't want to read metrics that aren't material to them either. They got better stuff to do. So I think, hopefully we can find an equilibrium.
Yeah, there's certainly a lot developing in that space, particularly around natural capital and accounting and so on. And there's interesting work done in the last couple of years in the UK around auditing on culture in organisations, which was coming towards the hidden capitals. And I would be remiss if I didn't point out that we are doing our own work stream on assurance in the PRI. And our working group has been looking at all of these issues, trying to see it from a perspective of our own reporting on what makes sense. And a lot of the same issues come up. But we'll be putting out a report on that towards the end of the year, which is looking at broader themes around kind of confidence building measures and internal verification and internal audit. And so all very connected. Eszter, I did just want to come to you quickly on the SDGs reporting aspect, and then we'll start taking questions. So I've already seen a couple of hands.
The SDGs being kind of, some people call it the risk framework for the planet. It's a very important lens, a very important set of issue areas that all businesses, or many businesses, are looking at and trying to assess their contribution or their impact towards. Now, the idea is to, rather than starting to think like, if the SDGs are out there, what can I start doing on it? It's more about, what is my business like? What am I doing? And how can I align my current reporting effort with how I impact actually the targets set out in the SDGs? And it is exactly in this spirit that we have approached this work with the UN Global Compact and their 10 principles and the GRI standards that cover a large number of the targets listed in the SDGs. How can companies start assessing their impacts and outcomes around the SDGs using the reporting practice they currently have? And this is very, it's an emerging practice, and what we have just, there's some companies who did the whole homework themselves. They took a huge Excel file and they listed all the targets and they just tried to see how it all fits together. I commend them on that. That's a really tough job. Now, hopefully going forward, companies won't have to do that. And they can look at what has just been released, which is kind of an analysis of the goals and targets set out in the SDGs, which is really looking at the what. What are the indicators that can be used to report on the SDGs? And we did identify some gaps that may be filled over time, but for now, that's where we stand now. And what we are focusing on in the coming months is the how. So this is where also the work with the PRI is of such importance, but also reinforcing the reporting standards, ensuring that reporting is timely and credible and understandable, and the boundaries defined, and the stakeholders are engaged for determining what's material to include in a sustainability or SDGs report. So making sure that the how is addressed and the outcome of that reporting process is actually meaningful and useful for the primary user groups. So that said, indeed, it's not a new report, and just like the TCFD, and if you look at the recommendations of the TCFD in the annex, it's really about looking at, okay, how can the current existing frameworks be helpful in reporting on the recommended metrics or disclosures by the TCFD. So don't worry, it's not about making more reports. It's about seeing how the data that you collect actually fits multiple purposes.
And I know you've also got your SDG report that recently came out from the IIRC as well, which...
We've made one contribution, which was a report you're referring to, where companies that are already doing integrated reporting about can see how they adapt the framework. But we're very supportive of what GRI and the Global Compact have done, and they've kindly invited us to be part of the second phase. And I think in terms of the metrics and the detailed metrics, I think that's doing some really important work, and we want to support it, and it's another very good example about how we're working together.
Okay, so any questions? One here. And can you say who you are and where you're from?
Thanks. My name is Regina Schwegler, InRate in Switzerland. I'm a quite intensive user of company reporting. I'm trying to get an opinion about the company's sustainability impact. And I'm responsible for the financial sector. And I've got some feedback, especially for GRI. What we would need is information on the really material issues in terms of sustainability. And what I would like to see, especially in the financial supplement of the GRI, is more product-related indicators, asking where does the money go to? Investments, credits, for insurances, what activities are insured, so that I can get a better opinion about those companies. So increasing the materiality of those standards, not just the GRI, but other reporting standards as well. And I think that the RI transparency report of the PRI is quite a good standard. Maybe that would help to have a look at that as well. Thanks.
Hello, I'm Piotr Biernacki from the Foundation for Reporting Standards in Poland and the Association of Listed Companies. I have one short comment and one question. The comment, in my opinion, there is no conflict between standardization and customization when we talk about ESG reporting. I think the issue is to be solved through a standardization and a good, well-done materiality study within the company, guided maybe through some frameworks, through some standards. That's the approach we've taken at the foundation and the association in Poland when we prepared the standard for non-financial information reporting. That was a work of the last 2 years, which is, I would like to say, it's not a competition against the GRI standards. It's rather a tool, a help for companies that start reporting non-financial information. But the question I have concerns integrated reporting, which was mentioned in the non-financial information directive as a goal, as a target that somehow the regulation should reach. So the question, I think, is mainly to you, Richard. How do you see the perspective, especially in the European Union, when we could finally have the integrated reporting in the EU regulation through a directive or through a regulation that would obligate companies in member states to use integrated reporting as a framework? Because, for example, in Poland, we have some companies that want to do integrated reports. They are ready, but they are being stopped by our local regulations, which do not allow them to do integrated reporting. So this is a barrier that should be broken on a higher level.
Well, the first question was aimed at Eszter, but the second, the only thing I would say to you on products and processes at a general level is that what we're trying to do, all of us, is get this out of an ESG niche alone. I think there's a continuing role for the leadership of the ESG niche. I don't in any way criticize that, but then the whole mission of integration is then to bring that into the mainstream. And I think addressing more the specialist products and processes, making sure the green bonds and others are robust is important, but we mustn't do that at the expense of also making progress on integration and addressing the big institutional investors on integrated reporting. On to our friend in Poland, thank you for the question. And I was the proposer, negotiator, and I'm known as the architect of the directive in my previous role. And so, by the way, I plead guilty for all the bad things. Yeah. That's part of my own accountability and transparency. But we're particularly grateful, and I'm particularly grateful to the European Commission, that in the commentary to the directive said that integrated reporting is the next step. And when we were negotiating it with Polish friends and others, I remember talking with IIRC then, and they say, we don't want this just to be regulation. If it's regulation, it's back to the old compliance mindset. It's just a cost to the company. It's just an add-on. It's not really about business strategy. It's not really about meeting the needs of the investor. It's about meeting the needs of the regulator alone. And so what we try to do is to find a way to be a regulatory nudge towards integrated reporting, not regulation of it. And that's still where I would argue we should be. So what the directive does, and for people who are from outside Europe in this audience, this year between 6,000 and 8,000 companies who've not been doing non-financial reporting will be doing it for the first time in Europe, and they will be doing it at the same time as their financial reporting, and many of them will choose to use the GRI, the IIRC II framework, or other existing frameworks in order to be able to do it. Now that, and then the guidance of the Commission very clearly says that. So I don't know enough about the detail in Poland, and we'll talk afterwards, but there was this discussion here in Germany when the directive, known here in Germany as the CSR directive, just to confuse everyone, was put through the Bundestag into national law. And then there was actually a debate, is this for integrated reporting or not? And there was an amendment on the floor of the Bundestag saying it is. So you couldn't get a clearer signal from the European Commission, from Germany, Europe's biggest country, that this is a step towards integrated reporting. So clearly, you and I need to have a discussion about how that's being applied in Poland.
Thank you. Any other questions?
I think Eszter had a question.
Oh, sorry.
Respond.
Yeah, I'll give you
No worries. No, I really appreciate your feedback, so thank you so much. And indeed, there is issue areas for us to learn about and to collaborate with others. I think when the GRI standards are developed, they're kind of having the broader kind of corporate community in mind, and we have not had the focus of looking at various kind of financial products and their role and their qualities. But that's something that I think we need to learn also from PRI. Now, the PRI reporting framework is more focusing on the process of integration, ESG considerations. The GRI framework and standards are looking at the impact and outcome of companies in terms of their environmental, social, and governance issue areas. But yes, I'm sure there's a lot to learn from the Green Bond principles and other tools out there that we have kind of bypassed. And GRI did have a financial services sector supplement some year ago that we need to revisit to improve our guidance and our standards that is more applicable for the financial community.
There's one question at the back, and then, two. This one, that one. And then after those, I'm going to ask everyone to do a quick summing up. And when you're doing that, if you can think about anything you want to tell the investors, this is a good time to do.
Hi, good afternoon. Shelley Alpern from Ceres. I'd like to hear the views of the panelists on the relative pros and cons of mandatory ESG disclosure requirements versus voluntary uptake, specifically coming from regulators and stock exchanges.
Who would like that?
I'm happy to have a go at that, but maybe also so do others. I think so. Also at GR, we used to work in the past few years mainly with governments and looking at state-owned enterprises and requirements for reporting instituted by governments, and we then moved so much more activity from the stock exchanges and market regulatory bodies, and every country, every stock exchange has their own approach. I really am a fan of what happened in Brazil, having Bovespa had a recommendation for sustainability reporting, and now they are looking at actually mandating SDGs reporting. So it's a matter of the evolution within and the maturity of the market in different jurisdictions. I see the merits of both. Still, sustainability reporting is, in many cases, still voluntary. For the GRI standards, we're neither voluntary nor mandatory. We're the standard, and it depends on the policy it's embedded in, if it's a recommendation or a requirement. I do warn about, however, what Richard already mentioned is, if we make it all mandatory, are we back to the compliance game? But maybe there's merits to mandating it to raise the bar. So
it depends.
It depends. Good. Sorry, it's a long version of it depends.
Does anyone else want to come in on that?
Sure. I think I'll put on the old accounting firm employee hat first. And from that perspective, I think having observed that profession, I would say there is some value in forcing compliance. But the way the audit process, at least not being an auditor and having studied the audit process, I just feel like it's a bunch of checklists you're following. And it's a compliance game, and it's making sure that the right sample files are sent to your auditor so that you make progress and you kind of have your clean books. And no matter what the auditor does, they may not catch certain fraud elements. So there is something to be said about, yes, there's value in compliance, but it's just still compliance-oriented, versus on the voluntary side, there is, if it's an industry-driven standard by the companies that are there, the professionals that are using the data, where it's most relevant, I think it's an informed decision to what matters and allows the flexibility as regulations change or trends and patterns change. If you think about cyber risk, I think any corporate CEO probably was thinking about it 7 or 10 years ago, but from a risk materialization and inclusion and valuation, it's taken so long. So it's let the organizations that best know the data inform the standard. So I can see both aspects of it, but there's value in an industry-informed standard.
But the accounting point is an interesting one, because you could make the argument that financial accounting, particularly if you're an accountant, might suit some business models in some companies and some sectors better than others. Yet there is, a gap, or U.S. gap,
exactly. There are multiple
IISB
standards.
or whatever. I mean, it's all over the place. So I mean, you could make the extension, at least for some subset.
Fair enough.
And this is why I think our investor group is coming up with probably a hybrid approach of some sort, avoiding the key details of which particular data points and who decides them, but maybe where we need to go, at least to get things going. Because obviously the con is that, particularly for ESG, industries are so different, and companies have different mixes of industries, even if they're broadly in the same sector. So that standardization is probably going to be less relevant, I would submit, for ESG than it might be for financial accounting. But I think maybe a starting point is maybe some small standardization.
So that one final very brief question again.
Hi, Andrew Giblin from Glass Lewis. I've had the opportunity over the past few months to ask a lot of issuing companies about what they're doing to prepare for the non-financial reporting directive requirements. And I have to say that far too often the answer to that question is, well, we're still evaluating our options, because there are still a lot of options out there. I mean, I think that's actually driven by the end user, as you're saying, George. Maybe not everyone wants more data to look at. But there seem to still be misconceptions about what non-financial reporting, what value it can add. I talked to a bank just last week, a listed bank, who said they would never consider integrated reporting because the only resource they use is financial. So I'm not really sure what happened to their employees or their customers, but that's another story. The question is, that bank had talked to its shareholders who said, oh, we don't care about integrated reporting. We don't know about any of that stuff. And I think that's the answer that comes far too often still from asset owners and managers. So what do we do on the education side to get people to know how to use the information and perhaps drive some of that change?
Does that come to your annual conference, which is in October, to find out all about?
I apologise for the fact the European Union, even though I don't work there anymore, uses non-financial reporting as a phrase. It's the one that's developed over a number of years, and it's difficult to change terminology when there are 24 different languages being spoken. It costs too much from the translation. But whenever I present this, I say it's intensely financial. It's financial in the longer term. And I use the words often pre-financial rather than non-financial. Now, I know that takes longer to explain, but the minute that you start saying that, the ears open and the eyes open up. And that's why we were all talking, and I was talking about materiality. If we really base this into materiality, companies having this broader view, having this connected, holistic view, having this long-term view, but then bringing it back to what is really material to them, their business strategy, and therefore long-term value creation for the investor, you won't get people saying we're not doing this. You'll get people saying, why aren't we doing this?
So I think that's a good summing up from your perspective. Eszter, do you have a final?
Thank you. Yes. I have 2 points. One is mainly to the investment community in the room. One is, I think this is all very important, and I do see an alignment. I do see how the different standards fit together and they serve different purposes. Maybe it takes a longer time for everybody to kind of see that fit. But one thing is, I think, is irreplaceable, which is direct engagement with the investee companies as much as possible to make them understand what is it that you need for your decisions, help them improve the reporting practice, or help just try to understand what they're trying to say. Maybe actually your investing companies are doing a great job, but there's not a direct communication, so that is irreplaceable. I would strongly urge everyone to do that who can. And the other thing is next to engaging your investee companies, also engage with GRI, help us help companies so that their reporting does become and remains investor relevant.
Great, thanks. Amisha.
Sure. I think just as I hear the panel and some of the questions, I think the biggest takeaway for me and the role providers could play is continuing our focus on transparency and quality of the data we are publishing so that investors know what's happening, and also training the investment community on the both sides and bridging that gap where we can, because most of us have customers that are investors as well as corporates, and the more role of an active role we can play, I think it helps the cause overall.
Thanks. George.
I think amongst our investment members at ICGN, there's still is a lot of confusion about how all these pieces of the puzzle fit together. IIRC, GRI, SASB, CDP, the whole alphabet soup. And I think it's probably clearer in a lot of your minds than it may be in ours. So I would think that there may be an education to help us understand where you're at better. And hopefully the initiative that we're undertaking together with you will lead you in that direction. How all these, and I think it's been very encouraging to see, for example, GRI and SASB write a joint statement. I hope you believed it all together, but how you in some ways are doing something similar. But to me, as an investor, and if we're looking at quality, sort of the data points, the atoms and molecules that you're building, hopefully are similar molecules in a GRI framework, in the SASB framework. Then I think that there's some hope for making sense out of this. Otherwise, I think there's potential confusion.
Great, thank you. Well, thanks everyone for joining us for what I found it super interesting. I hope you did too. Thank you very much to the panelists. Enjoy the rest of the conference.